Hey, what's up, folks? Welcome back to the channel. Today, I want to cover kind of a sequel to what I discussed in my last video about Roblox call options. And I want to go a little bit more in depth on options trading. I didn't really do a great job explaining options, and that wasn't really meant to be like a formal options training, just kind of an informal discussion. But I'll get more in depth today. So the title of my last video was it was prefaced with making $1,000 in 10 minutes. And that was true if anyone holding that option at the time sold it within 10 minutes of trading that day. But if they sold it that day, they would have actually been short-sighted because it continued to go up, because the Roblox stock continued to go up all week. And I'm going to show you just how well it did here. So, and it's going up despite the market dropping. It seems like we're in another little bit of a downturn. Hopefully it's not a black swan event coming like I referenced in one of my last videos. If you haven't checked that out, please do. It's my most popular video. Kind of surprised me. I didn't expect that one to be my most popular one, but it is. So anyway, if you see Roblox here, you see it opened the week, well, obviously where it closed last week, around $105 a share, but it's gone all the way up to $132 a share as of today, and it just really keeps rolling. So the call option we went over last week, it actually expires today. And this is a really good example to have this discussion on, because this one is a rarity. This one is actually going to expire in what they call in the money. So in the money, kind of like my shirt that you can see here, in the money on an option means that the strike price on it, which is the target price for the stock, for the underlying stock, actually reached that level. So say, like in the example of this option here, which I'm pulling up, where did it go? Yeah, it's up to $32. So, I mean, this is going to be mind blowing when I actually tell you what this would have been worth if you had bought and not sold when I mentioned last week, if you held on to it. So this option, the strike price was $100. So when they had their earnings blast last Tuesday, the option became in the money because the underlying stock price shot past the strike price. And now it's actually way in the money if you look at it, because the stock is about $132 a share. And you can see this option, if you were tracking with me last week, you saw how much lower it was than it is now. So this call option is currently trading at $32 per contract. So going back to the 68 cents that this was on November 1st, again, if anyone had held this the month before, they were looking at the prospect of losing their whole investment. So there was a miraculous turnaround on this once the earnings blast happened, but it got even better from there. So in that hypothetical situation that I mentioned, with the person gaining $1,000 in 10 minutes, if they had held this at the same amount, which was say 500 contracts, then that investment of say an initial $2,000 would be worth $17,000 today. So just in a week, holding it a week longer would have made the person another $16,000 in 1 week. Now, that doesn't happen every day, but when it does, it's phenomenal. Unfortunately, in that example, the person holding this would have panic sold when they, well, not panic sold, it was an exuberant reaction at that point to seeing the option go up after being down so much. So, I mean, there was no way of knowing that this was going to happen. Well, some claim if you do technical analysis, which I'm not a huge fan of, maybe I will become one as I kind of master that skill more. I've been more of a like long-term trader, but I'm learning more and more about different things that are more short-term, and that's what I'm here to show my audience. So on this one, oh, and another couple of things I want to talk about. So with options, you have delta and theta. Delta is how much the option contract is going to move up given a dollar increase in the price of the stock. So if the stock increases by $1 and the option has a delta of 40, then that will move up 40 times what the stock price moves up. There's all these different Greek letters. I'm not going to get into all of them now, but the main ones that you would want to focus on are delta and theta. Theta is kind of the bad one. That's the one that you want that to be as low as possible because that erodes the value of the option over time. And sometimes some of us that hypothetically may get into these and not really pay very close attention can end up in one where the theta is higher than the delta. And if you do that, you're going to want to get out of that one as quickly as possible. And again, this isn't advice. This is just entertainment and educational related content. So, but if someone were to do that, they would want to get out of that as soon as possible because the theta value or the theta, whatever the theta is going to erode the value of that option over time. That's why you see, well, in this one's going to end up higher than it ever started at. But that's why if you look at the chart here, you'll see that over time it kind of gradually declined because the theta, I like to call it like the tax of holding it every day. That's like your cost of holding it every day. But when you get a delta value higher than the theta, that's a good thing, providing that the stock moves. The stock price that is the underlying stock for the option has to move up. If it just sideways trades, you'll lose because theta will just erode the value of that option over time. And delta is not going to have a chance to work for you because the price of the stock's just staying sideways. So the option's not going to move up if the stock doesn't move up. If it's a call option. Now, I'm not going to get into put options or anything like that yet, but those are used very effectively for people also. Oh, and then the Warren Buffett strategy that I mentioned in my last video, because I started to mention it, but I didn't actually explain it because I was just rambling on. That's kind of what I do. I need to be a little more rehearsed when I do these. But what Warren Buffett does, because he's known as like the long-term, like the best long-term value and growth investor of all time. And what he does, because people think like when they read his books and stuff, or at least one of his first books, they don't realize that he's actually doing anything with options. They think he's just trading stocks and holding stocks long-term, which he obviously does a lot of, but he also uses put options, which put options are the opposite of call options. Put options are when you think the stock is going to move in a bearish direction, meaning that it's going to drop. You're kind of taking like a short position against the stock so that you would make money if it drops. So Warren Buffett, he's used put options as a very brilliant strategy to get into stocks at a cheaper price or collect what's called a premium if the stock never reaches the strike price. So a put option would work the opposite of a call option. If you think the stock price is going to drop by a certain amount in a short period of time, you can actually get into a put option and then hold that. And then if the stock drops and it's a great company, like with Warren Buffett, he always gets into great companies, great businesses. He vets them thoroughly. He's looking at everything. So he's not just throwing caution to the wind and just getting into anything. He's getting into a very good company that may have a short-term downturn, and then he's able to get in at a very cheap price. If the strike price of that put option drops below what it's slated to. So meaning that like if you take like Coke, for example, I think this is one that he's used this for. So like if Coke at the time was trading at $50 a share and he thought it was going to drop to like $40 a share, then he would get like a put option a couple months out with the strike price of $40. And if it fell below that, then he would automatically, now he would have to have the money to buy that stock, because then it would become in the money, and then he would automatically get into that stock. But if it didn't drop to that strike price or below, and the option expired, this is the opposite. See, call options, when I said they expire worthless, they don't all expire worthless, but with put options, you can collect a premium. You can actually collect a premium if the stock doesn't drop to the strike price. And you collect that up front, and you keep that. If it expires out of the money, then you keep that. So it's almost like a dividend in a sense. And those are two really good ways to make money with that Warren Buffett has actually done. And that's what I was referring to in my last video. I rambled too fast and kind of lost track of that thought. So I wanted to discuss that in this video. And I wanted to give a few more nuggets of information, like talking about the deltas and the thetas. I won't get into the other Greek letters. There's gamma, there's a few others, vega, and you can definitely find information about that in a more in-depth options course. And I'll get into that eventually, but I just want to discuss high level with Roblox as an example. So again, $17,000 if someone was in this and held it in a hypothetical situation, because remember, this is not advice, right? So anyway, please remember to like, comment, and subscribe to the channel. And I'll try to get some new videos out sooner than I have been. Thanks for watching this, and hope you have a good rest of your day.